To a webinar here with Advanta IRA today, where we are going to be talking about navigating the precious metals markets to protect your wealth. There's been a lot of movement in the economy since the last time we had our guest speaker on, so we're excited to bring our guest speaker on today to talk about kind of the current state of the metals markets, the prices, the effects that the different economic indicators are having on those markets, and really what you can do using precious metals to really help protect your wealth. As we move through the webinar today, if you have any questions for myself or our guest guest presenter, please type those into the question box on your screen. We'll make sure we get those questions answered for you during the course of today's webinar. My name is Scott Maurer. I am the Vice President of Sales here at Advanta IRA. I've been with the company for a number of years, working primarily initially helping process transactions, helping people process purchases into precious metals, but spend a lot more of my time now focusing on the sales and the business development side of the business. I'm a licensed attorney in the state of Florida, although I do not do any legal work for Advanta clients. My contact information is here on this slide. I'll have it up again at the end. So if you have questions about the IRA side of things, again, our guest presenter today is being brought on to talk specifically about the precious metals market. But if you have questions about IRAs, how they work, or how you could use those to invest in precious metals, please jot down my number, my email, and reach out to me after the presentation, or again, type your question into the box on your screen. Just a quick disclaimer: Advanta IRA does not provide any investment advice. We do not endorse any particular products. It is up to the individual account owner to do your due diligence on investments you're looking to make, whether that's investments in precious metals or real estate, and also do your due diligence on who you are working with. If you're buying real estate from someone or investing into someone's syndication or buying precious metals, it's up to you to do that due diligence. Our role at Advanta is to process the investments at your direction, making sure that you're not violating IRS rules as best as we can tell, and we can always refer you to CPAs and attorneys or other financial advisors before entering into an investment to help you do your due diligence on those aspects. Just a little bit about our company. We've been around for over 20 years. We have over $3.5 billion in assets under administration. We also dedicate an account manager for every new client that opens up an account with us to give you that real personal touch, having a specific person to reach out to, a dedicated contact. And we also offer a lot of educational tools and really committed to fostering an environment of learning amongst our clients and then the people in our database. And we do that through our weekly webinars. Today's webinar is one that we do quite often with our guest presenter, but we do at least one or two per week on a variety of different topics. And you can always find those upcoming events on our website. We also have a podcast hosted by my colleague, Alex Perney, who also brings in guest experts in kind of a shorter more conversational format than our webinars. Now, when we talk about precious metals in an IRA account, it's important to note that if you're looking to invest in these types of metals in an IRA, the IRS does have some specific requirements when it comes to purchasing these metals as an asset inside of your IRA. In fact, one of the biggest the requirements right up front is making sure that the metals have to be of a certain fineness. For example, most cases, the metal that you're purchasing in the IRA needs to be at least 99.5% pure gold or pure silver. And just because a coin was minted by a government does not automatically make it qualified for an IRA. It could be a US minted coin, but it could be done as a proof or some other type of coin that would be more of a collectible, and collectibles are not permitted within IRA accounts. Precious metals and certain coins and certain bullion bars are an exception to those collectibles, but you do have to make sure that the coin, the bars that you're purchasing are qualified to be held inside your IRA. It could be because of the fineness of the metal, could also be making sure that it's not a collectible, and it also could depend on the government itself. There are only certain government coins that would qualify. It could be a US minted coin, could be a UK minted coin, but they're not all different countries who produce gold medals and gold coins are going to be permissible. Additionally, if you're purchasing precious metals in your IRA, you must have that gold, that silver held at a valid depository outside of your physical control. The IRS rules do not allow you as the IRA owner to have that physical possession. Advanta right now works with 8 or 9 different depositories around the country that can properly store your metals and hold the metals so you don't have to worry about that particular requirement. There was a court case a few years ago where an individual client was using an LLC, where they were setting up an LLC for their IRA to own, and then as the manager of that LLC, they were personally custodying the metals in a safe at their house. And that court case basically stated that using that type of setup does not get around the requirement that you have a third party actually be in physical possession of the metals themselves. So just note, if you're buying the metals, you got to make sure that you're buying the right type, that they're IRA qualified, and then they're having those coins or those bars held with a third party depository. Most gold dealers can help you determine which products are going to meet that IRS investment grade criteria. So again, do your due diligence and make sure that you're working with someone who understands what those requirements are, and also be satisfied with what you are paying for those particular metals. So when you're buying the metals, make sure you understand that the difference between the spot price of gold or silver, and our guest presenter will talk about this a little bit in just a few moments, but the difference between what that price is on a day-to-day basis and the price you are paying is likely the fee that is being paid or being collected by the dealer that you're working with. So you always want to understand what your price is versus what the spot price of gold or silver is. You need to understand, again, what metals are acceptable to purchase inside the IRA. Check a few different sites. If somebody tells you one thing, would you go to another site and see that that metal is not listed as an IRA acceptable investment? Have that discussion, have that conversation, and why the party thinks that that metal is going to be acceptable inside of an IRA. Again, you have to have a whole metals at a third-party depository, and also understand that the process of buying gold and silver inside your IRA, or even probably in general, is time sensitive. A lot of the metals dealers, when they go to purchase, they put in an order for the metals, they put up the cash, and you need to make sure that you are working with Advanta to get your IRA involved before that process begins, so that we're ready to have the paperwork that you need to sign off on, so that when the dealer does place the order, we can then shortly thereafter get them the funds for that actual purchase. If you're about to go out of town on vacation, that's not maybe the time to be trying to negotiate your precious metals purchase, because you're going to need to be available to sign some documents and approve the transaction itself. So again, we work with several different depository institutions. You work with several different dealers. You can find your own dealer. For the depositories, if you have a specific one you like to work with, we can always entertain that, but we do prefer you to work with the depository institutions that we have a list of, and we can always provide that to anyone who's on the call or even after the webinar. But our main focus today is really understanding the current state of the market and how to use the precious metals to protect your individual wealth. And so we're happy to bring back on Greg Allen of Allenhouse Metals. He founded the company back in 2017. He's a frequent speaker. He's been on with us probably at least once or twice a year, talking about the markets and giving kind of updated with the different charts and the different, again, economic indicators that are out there. You can connect with Greg at allenhousemetals.com. At this time, I am going to change the presentation over to Greg and allow him to share his slides for anyone who's participating live. And Greg's going to share his slides, go through the presentation. And just a reminder, if you have any questions for Greg or myself as we go through the webinar today, please type those into your question box on your screen, and we will make sure we get back to those. But at this time, Greg, I'm going to turn it over to you. How are you doing today?
Awesome. I'm doing great. Thanks, Scott. Thanks for having us back on. These sessions are always great source of information. And, you know, just before I even get into the presentation, one thing I just wanted to touch on is product type and fineness requirements, because you were just talking about those yourself. And it's an important thing to note. One thing, and I say this virtually every presentation that we have, but if everyone took 3 things away from today's presentation, one of those things I want it to be is avoid collector coins and precious metals collectibles. When you're looking at precious metals, bullion is what you want to get what you're paying for. Okay, and so we specialize in what's called investor bars. These are kilo and 100-ounce bars of silver and kilo and 10-ounce bars of gold and platinum. These are all from government-approved mints. They have serial numbers on it. You're getting what you're paying for in them, rather than if you see the word fruit by the word of a coin. If you see a grade MS69, MS70, stay away. If you want to collect those items, there's nothing wrong with that. But for the most part, people in their IRAs are investing. So the priority should be getting the best price and the thinnest premium between the bid and the ask. And that's kind of what we turn to bars for. So just as we move into the presentation here, right off the hop, I think a big thing to stress is precious metals is no different than any other investment, in that there is no one-stop answer for everyone that covers the whole market. Every portfolio is unique. And so at the top of it all, your investment objectives need to be priority number one. At the end of the day, your risk tolerance is what will indicate how you should allocate your portfolio. And we want to make sure we give everybody that tailor-fit experience of something that's allocated directly for them. So Gage is our service provider. We work exclusively with them for metals. They are the authorized purchaser for the United States Mint, the Royal Canadian Mint, as well as virtually every government mint around the world. Okay, they've been doing business since 1976, and they are just about one of the largest precious metals importers in the world. They are the ones that service major banks and government facilities alike. And basically through us, we allow people to go directly to them. Moving on, when we talk about depositories, and Scott had mentioned there's several, I think 8 of them you can choose from at Advanta. We work with all of them. However, we personally prefer to work with IDS Texas. IDS is a wholly owned subsidiary of Gage, the purchaser for the mint. They have every certification there is, from ICE to COMEX to LBMA. And additionally, for us, we like working with IDS Texas the best because the vault space is in the same building as our distribution facility. So one thing to keep in mind, if you haven't dealt with in metals before, is you need to ask at your initial transaction how the process of getting liquid works. Not every dealer you talk to will buy product back from you. And that's important to know right off the bat, is how do I sell it? Will you buy it back? And what will the terms be? So we prefer to work with IDS Texas because in situations in which you're selling, we're typically able to make people liquid within 2 to 3 business days, just like selling a stock. So when we talk about precious metals, most often they're referred to as a safe haven, okay? And when we refer to them as a safe haven, we're referring to in times of geopolitical tensions, in times of economic turmoil, precious metals typically surge in value while paper markets plunge. But I think one thing everyone will learn today is precious metals are not just an insurance policy on your wealth. They're something that can perform consistently for you in a portfolio, and they should be a consistent basis for your portfolio. So one thing here in terms of moving on, precious metals is guaranteed to hold its intrinsic value, right? It's not going to zero. It rises in value with the cost of inflation and the cost of living, okay? There are no credit risks whatsoever. We actually have clients, for instance, who have precious metals that they've used as collateral for a mortgage or for other loans in terms of investing. And the big thing I would like to draw a distinction from, because a lot of people ask, what is the difference between buying the ETF, the paper gold and silver, versus buying the physical gold and silver? And the main thing I would state is that before 2020, a lot of people would jump into the ETF because of liquidity concerns. You knew you could sell it just like a stock and you would be liquid. This has changed a lot in the last 5 years as we've taken that away. You are fully liquid at all times within your IRA account or your non-IRA account. The other distinction I want to draw is in the last 5 years, because there's been a major supply and demand imbalance in gold and silver, which has caused the price to go up by so much, these ETFs changed their perspective 5 years ago. They no longer back the funds with physical metal. They used to back them with roughly 30%. And they also have a clause where they can liquidate at any time and give a liquidation value without investor approval. And so the big thing is, since this change, bullion outperforms ETFs in the market, and ETFs do not track the bullion market as closely. And that's something that I will show you guys in a future slide. So one big thing, we talk about inflation and we talk about, gold and silver rising with the cost of living. I think this is a really good example right here. If we look over roughly a 50-year change, the cost of a Corvette changed by roughly $62,000. It went up. But the cost to purchase that Corvette in gold or silver, it actually went down. You can see from 135 ounces to 38 ounces of gold, and from 3,600 ounces of silver to 3,300 ounces of silver. But more profoundly, I want to highlight how this has changed in the last 5 years, right? You'll see this decrease in the amount of ounces it takes to purchase over 50 years. And we've seen a similar decrease just in the last 5 because of how much our purchasing power has eroded. So that Corvette from 2020, the base price in 2025 would be just above $70,000. So it's gone up by $3,000 or $4,000. However, instead of 38 ounces of gold, it would actually only take 18.5 ounces of gold today. So less than half of the ounces of gold would buy you the more expensive Corvette just in 5 years. And instead of 3,300 ounces of silver, it would only take 1,573 ounces of silver. So what we've seen is in the last 5 years, gold and silver have effectively doubled their value to inflation, or rather in the cost of living. And we're seeing this major shift, especially since printing with COVID. So one thing I want to really highlight here is monetary policy, right? I'm sure everybody was paying attention to rates being cut last week. And the big thing is, the number one factor that everyone needs to remember that will affect the price of gold and silver is the US dollar, okay? Gold and silver's inverse relationship with the US dollar. So all that means, as the dollar loses value, gold and silver gain value. They get more expensive, and vice versa. If the dollar gains value, gold and silver get less expensive. And so the most important thing to tracking where do we think gold and silver are going is what is the forward guidance from the Federal Reserve, and what are we seeing happening with monetary policy. So this dot plot that's in front of us all right now, beg your pardon, is the latest dot plot from the Federal Reserve, okay? This was released last week. What it shows is including the cut we saw last week, we expect 75 basis points or 3 interest rate cuts this fall, okay? What this shows in front of us is each dot is representative of a decision maker at the Fed. So they are showing interest rates settling at end of year between 3.5 to 3.75%. They're showing 1 cut next year and 1 cut in the year following. One thing I want to emphasize to everyone, typically I would take the guidance as it stands. Keep in mind, one major initiative from this administration, from the Trump administration, has been to reduce rates as much as humanly possible. because the government has to refinance its debt, trillions of dollars worth of debt. Powell's term is done in May of next year, okay? And I don't think there's any way he's going to be out early. And so if we're looking at this, we look at who his successor could be. The current favorite, it's not going to be Scott Bessent. He's not going to leave the Treasury. The current favorite is Christopher Waller. He is in favor of changing policy outlook. Right now, it is considered that the Fed is reactive, right? Powell looks at data over long periods of time, and they slowly make changes in reaction to the data. Christopher Waller wants to be proactive, not reactive. So he wants to make these decisions in advance to curb what could be coming. We believe, according to what Christopher Waller's saying, that they will attempt to get at least until neutral territory at 3% next year, which would be a further 3 interest rate cuts. So what we're forecasting is 5 more interest rate cuts between 2 this fall and 3 next year. Now, moving on here, how does that relate into what experts are saying? Well, you'll see here, this is the CME FedWatch tool. And to everyone listening, I urge you to Google the CME FedWatch tool. I think everyone should use this. It is a survey of experts in the percentage chance of different rate changes at Fed meetings. What you see in the chart here is their current end of year Fed meeting projection. And you'll see there's a 73.3% chance, and 73.3% of experts agree that we'll have 2 more rate cuts. 25% agree that we'll have 1 more rate cut. But unanimously, except for 1%, we agree we're going to have another cut this year. Now, what do rate cuts do to the dollar? And this is something I just wanted to demonstrate here. What you're seeing here is the US dollar index. If we look on the chart, this almost looks like a cup and handle, which it is. And if we look at the cup on this, and I don't know if you can see my mouse going around the screen, but if we look at the bottom of the cup, following interest rate cuts after COVID, the dollar bottomed at 89 on the index, okay? Now, from 89 on the index, we saw conducive multiple interest rate hikes for over 18 months, right? What you will see in response to interest rate hikes is it looks like stairs. There's a step almost every hike. The dollar went all the way to 115. Since then, the dollar on the index is down 10% this year, which is why we've seen these huge jumps in value in gold and silver. But remember this 89 level on the index, because I will show you in a further chart why that's so important. The gist to take away from this chart right here is as rates are cut, the dollar falls in value as the yields fall. As rates are raised and the yields raise, the dollar gains in value. This has nothing to do with our actual purchasing power. I will make that distinction. This is the dollar as compared in a basket of 6 currencies on the index. So this is what we track when we're looking at gold and silver prices. So moving forward, what I want to show on this slide is a key technical indicator here that we're looking at in the US dollar that is dead opposite to what we see in gold and silver. If you track the blue and the red line that move across this chart, the red line is the 200-day moving average. The blue line is the 50-day moving average. And if we track this back to May, before there were any rate cuts this year, what you'll note here is the blue line crosses downwards through the red line. What it means when the 50 crosses down through the 200 is it's referred to as a death cross. A death cross is one of the most bearish signals you can see when evaluating a chart. This signal does not just apply to the dollar or gold or silver or stocks. You can use this on anything. But the death cross I was just saying is the most bearish thing we could possibly see in the dollar. And this is coming just as we're starting our rate cutting for the year. Now, what I wanted to show in terms of this growth is we've just been talking about forward guidance from the Fed and interest rate cuts. How do these directly affect gold? How do they directly affect silver? Well, in looking at this is every rate cutting cycle displayed since 2000. The chart's kind of cut off on the left. You'll see it starts in 06. The average gain from valley to peak in gold during an interest rate cut cycle where we eventually saw a 0% rate was 145%. Okay? And this is directly due to dollar devaluation. Another statistic that's in the same realm, this is silver. The major interest rate cutting cycle since 2000. Okay? You will see we have a major cycle here from 03 to 07. We have another one following the financial crisis, and then we have post-COVID. The average move in the price of silver during an interest rate cutting cycle is 413%. So by no means am I sitting here saying that silver is about to quadruple in the next 3 months, because it's not. However, this is to say, in bearish circumstances for the dollar, we have done extremely well with gold and silver over the last 20 years. Now, looking at this chart right here, I wanted to put this in to stress the importance of what we're seeing at the moment. This is what we're referring to as a commodity super cycle. And the reason we're referring it as a commodity super cycle is because we're in an anti-dollar phase. We, as a country, we are actively devaluing the dollar and cutting our rates and refinancing debt. And all commodities settle in US dollars. So by definition, the whole commodity market is coming up along with gold and silver. And so this has only happened twice before in the last 100 years. The only other times we've had opportunities in commodities, and specifically precious metals, is from 1971 to 1980 and from 2006 to 2011. This is the third commodity super cycle. And this is not to say you can't consistently make money in gold and silver. This is to say it is not every year we are able to make 40, 50% in a calendar year in gold and silver. Typically, it is like watching grass grow, and it averages in the 9 to 10% realm per year. So this is a serious opportunity ahead of us. Now, I wanted to highlight some year-to-date performance, because last time we all met was in March. If we look at it, gold on the year so far has done 41%. Silver is just over the 53% mark. The S&P 500 is 14.1% positive, and Bitcoin is 21%. So if we evaluate this amongst other markets, silver is by far the top performer, and gold is close on its tail. And this goes to highlight what I was just talking about. Gold and silver are never a bad investment to make, but it is not every year that we can pull out 50% like we're seeing at the moment. Okay? And so moving on, one thing I wanted to highlight with this, and you will see this is as of the end of August. So since we've had the Fed meeting this month and we've had a few weeks, obviously silver is up actually 14% in the last month, and gold is up 10% in the last month. What I wanted to show with this chart is the difference between your average ETF and your average piece of bullion. If you look at this, gold bullion and silver bullion, they're each up over 30%. As we just saw though, gold is up over 40, silver's up over 50. If you look at gold and silver ETFs, they're up just over. they're up just over 10%. And so why that is so significant is these ETFs are not as profitable anymore. And it is because these ETFs are not backed by the physical asset. And so thus they do not track the actual physical gold and silver markets as closely.
Hey,
So,
Greg, I had a quick question, if you don't mind, jump in
yeah,
there on that. So you talk about the ETFs. How would someone even know that that's the case? Because again, for a lot of people, like, oh, buying gold or silver through my IRA means I need to set up a self-directed account, I need to find a
yeah.
dealer, I get it, et cetera. It seems more cumbersome than simply, hey, I can just go buy a gold or silver ETF because that surely must track the same thing. How would someone, the average person, know that that's the case when you're looking at kind of I mean, obviously this chart is extremely helpful and shows it, but someone on their own saying, how would I know that I don't, that silver, the ETFs aren't really have the same backing that they used to?
Well, so this is, and that's a fantastic question because it's the truth. You wouldn't. And so part of the thing is they are counting on you not being educated on that so that they can sell you their ETF product, right? One of the references I always make is, if you go to a stockbroker to buy physical metal, it's like walking into a GMC dealer and asking to buy a Ford F-150. The thing about it, and not to be coy, is that they don't make money on selling physical gold and silver. And so then they don't do it. They only sell products that they have a hand in making a commission, rather the broker at these institutions. And so their first thing when people want to buy gold and silver is to turn to put them into the ETF. And what I always try to say is pre this change in 2020, that wouldn't have been a bad decision, right? Investopedia actually states that prior to 2020, only 5% of investors that were accredited held physical metal in their portfolio. The number has changed since this change has been made in the prospectuses to actually 33% of accredited investors had physical metal in their portfolio as of last year. And now the reason, and I know I might be droning on about the ETF thing now, but I want to just bring this home. Part of the reason that it tracks so sparsely and it's separated so far from the physical asset is because not only did they stop buying the physical product to back these ETFs with, but they actually sold off a lot of their holdings. And the reason is sheerly from a cost-cutting perspective. You have to think of it in their shoes. When they realized they didn't have to buy physical metal anymore, the next thing they thought was, well, hey, if we don't have to buy physical metal, we don't have to pay an overhead to store the physical metal. And if we don't have to pay the overhead to store the physical metal, their overhead as a whole on the fund and the premium they collect is higher. So they're making more money, if that makes sense. But a very good question, Scott, because the real answer is, unless you were an incredible researcher, if you weren't in financial services, that's just something you wouldn't know. So what I wanted to highlight with this slide, part of it is actually what we used in March. And I wanted to show everyone the most aggressive projections for gold for the year for March were Goldman Sachs and HSBC. Originally, they forecasted $3,500 this year, and they changed that forecast to $3,600 to $3,800. And to give everybody an idea kind of on how they've done with that projection, this morning, we hit $3,790 gold. So we are within $10 of the year projection. But most significantly, I want to highlight that Goldman, they've come out and they've highlighted a $5,000 gold projection by the end of 2026. Okay. And the big thing that they're citing in this is a loss of independence in the Federal Reserve. And now, when we think of loss of independence, they're papering this in a different way than the traditional investor would interpret that statement. What Goldman is seeing here is that the Fed right now, Jerome Powell's publicly said he doesn't want to cut rates, but he's cutting rates because of the economic pressure on him. The thing we need to remember is Trump has the ability to replace him and will replace him in May when his term is up. So what Goldman is highlighting is that they understand the president will appoint someone who has a sheer mission to slash rates. And the bank believes that by slashing rates and getting to neutral territory and 3%, that will carry us to $5,000. If you look at what JP Morgan Chase is saying, JP Morgan Chase is a more conservative estimate. They're calling for 42.50. That is a move of roughly 20% from where we are right now. And the reason that they're highlighting gold right now, they've called gold as the top performer in commodities the last 2 years. They're calling it for a third year in a row. Maybe silver this year, as you guys can see, but they remain in that precious metals is the #1 hedge to protect yourself in the market. Now, one thing I just want to show everyone is this dollar chart, which looks very busy, and I want to break it down to everyone in terms of where we're going with gold. So one thing you notice is there's two head and shoulders formations in the dollar chart. The head and shoulders is not something we're going to be focusing on for this. These are a bearish signal, and because you will see the head above the shoulders. But if we look at this does an excellent job in showing us what levels we will see in gold trading as the dollar breaks down. So as of today, the dollar is trading in the mid 97 range, okay? Everyone will remember that we highlighted in that dollar chart a little bit earlier. I told everyone to remember, we hit 89 on the index in 2020 and 2021 when we saw those interest rate cuts. What you will see here is with this downward yellow arrow, it points and it comes to exactly where 89 on the index is. Where Goldman Sachs is getting their projection is purely off dollar devaluation. Now that we're below 98 on the index, the next major level of support, there are level of supports immediately below us, but the next major level of support is 89. So the bank looks at if the dollar falls from 97 to 89, where does that put us? They have assessed that 89 on the index is going to give us $5,000 gold. So moving forward, I wanted to show this. This slide in terms of projection is exactly what we showed in silver at the start of the year. The LBMA, the London Bullion Market Association, was forecasting 45. Other banks were just showing silver going above 40. And to show how accurate they've been this year, this morning we hit $44.51. So all of the banks are correct in that we got over 40. We are just about to reach that LBMA projection of 45 for the year. But significantly, they are forecasting a move to $60 by the end of 2026. To put that in percentage basis, $60 silver would be it would be a move of roughly 35% from where we are today. And so while a $15 move in silver is massive, don't get me wrong in that. When we consider what silver's done this year at 52%, they are forecasting less returns next year than we've seen this year, and we're still forecasting 35%. There is just no better way to make money at the moment. But if we look at silver, this is a key thing I want to highlight. I'm not sure how many people in this webinar remember. Previously in 2011, after the financial turmoil and the financial crisis, we saw silver hit $49.82 an ounce for all of a few hours. It went straight up and straight down. You see that shown here on the chart. Now, a lot of people look at $50, and that is thought to be the end all be all in silver. And what I want to highlight here is why that. We look at the cup and handle. The cup and handle works again in all tools, whether it's Microsoft stock, Apple stock, or gold and silver. The depth of the cup indicates the future price. And if we look at the breakout point on the handle, the breakout point on the handle is $50, okay? And so I emphasize this to say, if we look, the depth on the cup comes from 50 all the way down in the valley to $3.50. So effectively what we're saying is we have a depth of $46.50. If the breakout point is $50, that would state that the multi-decade cup and handle we're looking at projects an overall future price of $96.50. Okay, so 50 is far from the end for silver, but realistic projections over the next 12 months put silver at about $60. Now, I wanted to show this silver chart in recent performance to show just why it is the opposite of the bearish signs we're seeing in the dollar right now. If everyone remembers, we were looking at the blue and the red line when we looked at the dollar. The 50-day moving average, again, is the blue line. The 200-day moving average is the red line, okay? In the dollar, if we remember, when the 50-day crossed below the 200, it created what was called a death cross. In this case, the blue line has crossed up. So it's the polar opposite in how it's crossed up. And this is referred to as a golden cross. It is about the most bullish signal that you can see. What I want to highlight is that you will see this blue line formed a golden cross in April of 2024. And that blue line has remained above the 200-day moving average since then, for a year and a half now. And the one thing I also want to highlight when you look at our protected trading range, and when I say that, I'm looking at what is the downside if something unexpected was to come out of the blue, which, to be frank, unexpected typically benefits gold and silver because they benefit in times of uncertainty. But if you look to this line 2/3 of the way across, you'll see there is a momentary time in April of 25 there where the price of silver dips below the 200-day moving average here. That was the announcement of tariffs. So just to show everyone what tariffs did to the market, the one time we fell through our level of support was tariffs. Once the market rationalized those tariffs and we saw trade deals, you see immediate bounce back, and we've gone straight up from there. And so I wanted to highlight in this, not only is that indicator the dead opposite of the dollar, but we also look at what does silver do, what does gold do in response to crisis of an unknown tariff that's announced out of the blue? Well, it didn't really shake the market too much now, did it? So moving forward, I want to highlight the gold to silver ratio. When I talked about at the start of the presentation, the three things I was hoping for people to take away today. Number one is don't buy collector coins. Number two is that the dollar is the sole thing to consider when considering gold and silver. The third thing is the gold to silver ratio, okay? It's a really simple tool that allows us to determine whether gold or silver is the better value, okay? All you have to do is divide the price of gold by the price of silver to determine it. The average since 1953 has been, since 1915 has been 53 to 1. The average in this century has been 67 to 1. But I want to do an exercise with everyone here to show how did the banks get the projections for silver? Okay, we know with gold it's the dollar. How do they get it with silver? Well, the two of them trade in tandem. Okay, gold moves first, and then silver typically follows. And so if anyone has their iPhone on them right now with their calculator, open your calculator out, and if you type in $5,000 gold, what I want to show you all is currently that ratio is 85.38 to 1, meaning you could buy 85.5 ounces of silver for every ounce of gold. What we see here is that we know anytime it's wider than 80 to 1, silver outruns gold 4.5 to 1 on a percentage basis. it tells us silver's undervalued. But I want to suggest, what if gold moves up to 5,000 like they're suggesting, but the ratio does not close one bit? If we took 5,000, divide 5,000 by 85.38, what it will give us is $58.50 silver. Okay, and so what I want to say to people is, if gold moves and the ratio doesn't change a bit, that gets us pretty much to the projection from the banks. But I want to go one further. If we take $3,800 gold, which is where it is today, and as I said, gold's the first mover, silver follows and plays catch up, and that's what it's doing right now. If we said, let's say gold doesn't move another penny from today at $3,800, and let's say silver closed the ratio to the average, which we're saying is 67 to 1 this century. If you take $3,800 and you divide it by 60, that would give you a price of $56.72. And so what I'm trying to show you here with the gold to silver ratio is silver is bound to go above $50, even if gold doesn't move a single penny. But if gold does exactly what the banks are saying it will do, at 67 to 1, it gives us $82 silver ultimately when it catches up. And for reference, the last time this ratio closed to 67 to 1 was as recently as 2022. So moving past here, a little update on outside markets, because again, like we were saying, this is a broader commodity market boom. What I have up in front of us is what's referred to as the Buffett Index, okay? The Buffett Index, a simple comparison of the total market capitalization of the stock market compared to the GDP ratio, the gross domestic product of the United States. And so Warren Buffett says, if the stock market is between 75 and 90% of the gross domestic product, then stocks are a good buy. If it is more out of whack, if the stock market's capitalization is over 90%, then the stock market is overvalued. And this has been very accurate. As you'll see, it's predicted some major recession. Now, one thing I will highlight, prior to the dot-com bubble, the all-time high was 110. The dot-com bubble saw us get above 130. We are at an all-time high at 214 on the Buffett Index, okay? And so what I want to suggest by this, I want to also give the other coin, because there are people that say the Buffett Index is less accurate now because there are companies that operate in other economies outside the US on the NASDAQ. But what I would like to suggest is the indicator is over double overvalued rating that's suggested by Buffett. And so this shows us just how overvalued the stock market is looking at the moment. Now, in terms of allocation strategy, I always like to show this pie chart for people because this is a study that was done over 50 years. And over 50 years, CPM Group said, let's test different allocation strategies and let's see what is ideal to perform for an investor in all economies, good economies, bad economies. What's a set it and forget it allocation? What they determined was that investors that had 25% of their portfolio in precious metals and 75% balance between stocks, bonds, and other investments found the most success. They averaged 9.3% a year in returns over 50 years. What else they noticed, they determined an aggressive investor as somebody with roughly 6 streams of income. They stated the ideal allocation for someone with 6 streams of income would be 10% precious metals, 7.5% in bonds and fixed income, and the rest of their portfolio in stocks. But what I would also like to show is Ray Dalio. Ray Dalio is the founder of Bridgewater. He went from a lower middle class family to owning the largest hedge fund in the world. He himself has, I beg your pardon, he has 7.5% of his portfolio in physical metal. And now, one thing I would like to highlight is the only adjustment that's been suggested to that portfolio allocation as recently of June of this year is Bank of America and Goldman Sachs. I'm not sure how many people on the webinar are familiar with the 60-40 portfolio. Typically, Bank of America and Goldman Sachs recommend 60% stocks, 40% bonds and T-bills for safety. Now, both have switched these recommendations. They both now are recommending, first, Bank of America 40. I apologize. My headset keeps going in mute there. First, Bank of America recommended 40% in commodities, highlighting gold as a top performing commodity. But in June of this year, Goldman Sachs came out directly. You can find the article online, and they recommended 40% of the portfolio being put into gold because commodities will outperform bonds with rates falling for at least the next 2 to 3 years. And so their perspective is put your money in the top performing commodity. That is gold. And this year it's actually going to be silver. And so they're to up your allocation from 25% to 40% at the moment, highlighting the outperformance of the bonds. This is the last thing I'll show you from that CPM group study. It is a risk versus reward chart. And the way it is read is that the more risk you're facing is not risk that you face as an investor. It's risk that you face in missing out on a higher return in a potentially riskier investment. And so if we look at this, you will actually see as the allocation of gold goes up, the average return also goes up. But so does your risk in missing out on other potentially riskier, more profitable opportunities in the short term. So the reason CPM Group came up with 25 to 30% allocation is because that is on the peak of that risk curve while still obtaining a fantastic, consistent return. So one thing I urge, we really pride ourselves on our financial literacy and our education tools. Whether you want evaluation on an account that you already have, you want a quote, or whether you want to learn about potentially doing more in precious metals, we're happy to answer any question, okay? And so we are, even though our warehouse and our distribution and our depositories in Texas, we're based here in Palm Beach, Florida. And I urge anyone, there's our office phone number right there, my direct email, if you have any questions, any concerns, anything that you'd like some more information on, don't hesitate to send us an email or give us a call.
Hey, Greg, great information again. I think I always enjoy hearing you come on, and because the markets change, right? And the circumstances change. Every time we've had you come on, it's been a little bit different presentation because, like I said, interest rates change, the economy changes, the other markets change. It really affects, obviously, the precious metals market as a whole. So thank you again for coming on and sharing some information with us. Again, if you're listening live to the presentation, get your question typed into the box here, and before we wrap up, we'll make sure we get it asked of Greg. So I guess, Greg, the thing now will be really to watch kind of, the rest of the year. I'm not sure if there's going to be another Fed rate cut. I know it's kind of been hinted at, or it's possible, but I think it's more so I think it sounded like when we were gathering too, next year is going to be whether or not, Jerome Powell is still the Fed chairman, or he's probably not going to be come May.
No, exactly. So really what we're looking at in our factors here is the Fed is saying they're going to cut rates twice more. Experts are saying that there's a 99% chance they'll cut once more. There's an if there on the second one. I believe we're going to see 2 more 25 basis point cuts this year. The other thing is, though, is we have to realize that Powell's term is up in May. So whether Powell likes it or not, he's gone in May. I truly believe that what is more likely to happen is we will see 2 to 3 cuts this fall, including the one we just had. We will see a pause most likely at the start of next year, and we may see 1 cut before Powell leaves his term. But I believe Christopher Waller is who they're going to appoint in May of next year, and I think overall on the year we're going to see 3 next year. So effectively, what we're seeing, I think overall 3 cuts in 20, and I think 3 cuts in 26 as well.
Yep. Yeah, and we'll see. And what do you think some of the again, people who are watching this, what do you think are things that might affect that? Is it kind of if the cuts cause inflation to tick too much higher, they might step back from those? Is that kind of the main factor, or the other geopolitical things that could happen as well?
So politically speaking, and I'll be frank, I try to stay as far away from the political spectrum as possible, because we know political spectrum is very opinionated, and we're just trying to operate with no gray area in the facts. I think the big thing here is politically, they are doing everything they can to put pressure on Jerome Powell to either get him to cut right away they want or get him out of there. Realistically speaking, I don't think they'll be able to do anything to get Powell out of there before next May. So in reality, when we look at why the Fed's making these decisions, they have a dual mandate. That dual mandate is employment and inflation. And the reason they're making these cuts right now is because the jobs market is weak, and they have to make these cuts to support the employment market, even though inflation has ticked up a little bit. I believe because interest rates are still higher than the rate of inflation, that they will tackle inflation with cutting these rates. But the fact of the matter is, Powell is a man of consistency, and he tended to do exactly what he's forecasting he'd do. And he is not able to let the labor market go into turmoil when he stated very clearly that their dual mandate is inflation and employment. So yes, if inflation were to surge out of control unexpectedly, they could raise rates again at another quarter point. I think that's very unlikely, because I think we understand the tariffs extremely well now. I don't think those are a huge factor anymore into our inflation rate and what we're seeing right now. And I really do think that we're going to see 2 more cuts this fall.
All right. Well, Greg, I'll tell you what, we'll look forward to having you back on maybe the early part of next year to kind of see what has transpired, obviously, throughout the rest of the few months this year, and the early part of next year, what happens. I did have a question come in. Let me see what that came in. Someone said, with FI and other states using gold as currency, what are your thoughts on gold backs compared to fractional gold?
I mean, I think that's a good question, and it's a good point too. 12 states now use gold as a currency. So for anyone listening that doesn't know what that means, you can actually pay your property tax bill in the state of Florida with physical metal. The one thing I would say when comparing gold backs to fractional, to be frank with you, I more favor just buying bullion and using different products that are there to spend that bullion. Instead of using a gold or fractional, because the reason I don't like fractional is fractional comes with sometimes with an increased premium that you may not get back when you sell, because it's more work to mint the tiny motives. If you actually look into this, what you will see is you can buy gold bullion, silver bullion, any type of bullion. If you have it in a depository account and you're looking to spend that, there's actually a credit card you can get from Brinks now, which will allow you to spend your gold and silver in exact amounts at market rate, as opposed to losing out to the premiums on buying fractional and then negotiating with someone to take it, if that makes sense.
Yep, yes, it does. All right. Well, again, Greg, thanks. We're up against here at the end of the hour here. Thank you again for your time coming on today, sharing this great information. If you're looking for more information on gold, kind of the markets, et cetera, here's Greg's contact information. Please do reach out to him. He's been on, like I said, been on our webinars numerous times and always had some great information from that educational perspective. So please do reach out to Greg with those questions. And if you have any questions on the IRA side, don't hesitate to reach out to me as well. Here's my contact information. We look forward to thank you again for everybody for attending live. Greg, thank you again for your time and sharing your knowledge with us today.
Thanks for having us on, Scott. And as usual, we always look forward to the opportunity to come on and share some of our knowledge.
All right. Thanks, Greg. And thanks again for everybody watching. And hopefully we'll see you on our next webinar.
Thank you. Bye, everyone.
Bye.